Banks now have $213 billion in term deposits. But is saving the right strategy if rates won't stay this high?
That's the issue. People are eroding their purchasing power by and large by using these as a long-term investment vehicle.
We have seen an influx of TDs over the last sort of 2 to 3 years. As I think the interest rates have shot up.
It's Friday the 9th of February and you're watching Markets with Madison. The amount of money in bank term deposits has grown by 36% in the past 3 years as people chase higher interest in this higher rates environment. But they're now coming with a warning that short-term gain may make for long-term pain. Banks have seen an influx of savers locking their money away in term deposits. It's been rising steadily over the past few years, ticking over $200 billion in recent months. The reason is obvious. As mortgage rates rose for borrowers, so too did rates for savers. In December, you could earn 6% on average on a 1-year fixed TD. That's up from a less than 1% return only 2 years ago. TDs are currently beating the rate of inflation, and they outperformed the return on the New Zealand share market last year. The current TD rates even beat the average KiwiSaver conservative and moderate fund returns in the year to June. But Ben Kelleher from Concilium says TDs shouldn't replace investing. He's concerned people are picking TDs over equities.
What we'd hate is an investment being used for the wrong purpose. And so when you see a term deposit being used for a long-term objective, when it's really by nature a fixed short-term holding, then you scratch your head and you think this is something people are missing out on the benefit they could get by investing. And you feel like there's an educational gap, and every once in a while you get so frustrated you want to do something about it.
According to Trading Economics, New Zealand's deposit interest rate has averaged 4.27% between 1981 and this year, compared with the US stock market's average annual return of around 10%. ANZ's head of retail banking, Ben Kelleher, says it's seen customers run to term deposits. As the biggest bank, ANZ holds about a third of all of them. In this interview, he tells me how quickly those high rates may fall, leaving savers back at square one. Ben, good to see you as always. Thanks so much for coming on the show.
Thanks for having me.
So $213 billion as at December last year held in just term deposits by banks. ANZ's one of the biggest. So how much of that have you got?
Roughly about 30%. Yeah, so we are the largest. And we have seen an influx of TDs over the last sort of 2 to 3 years, as I think the interest rates have shot up, right? So we were, in 2020, I think we had a low of interest rates around 1% across the market, maybe even slightly lower than that for term deposits. And now we're up just above 6% for like a 1-year TD. So it's really shot up, and we've sort of seen that escalation of customers moving money effectively from transaction accounts and from savings accounts and chasing that higher return in the term deposits.
Have your customers been asking you to be put in term deposits, or have you been pushing them as a sort of high savings interest account?
We haven't really needed to. We do have those conversations, but actually just the interest rate itself, when it was 1%, I think people sort of sat on their hands and thought, why would I almost bother putting it into a term deposit when the rates are so low, with the OCR being so low? And now they've shot up, people are going, wow, 6% or thereabouts, pretty good return. At the moment, recently the stock markets have been a bit choppy, so people are a bit nervous about that. And if you need a bit more certainty, which some of our customers do and then it works well for them. And I would say roughly about 70% of our customers are over the age of 55. So it does suit a lot of that older demographic.
Yeah, we're told that the TDs are typically for that older saver, so that is definitely what you're seeing. That's yes. The demographic.
Yeah. I mean, we have all ranges of customers. We have young customers, kids that have got savings accounts or term deposits that have set up. But generally speaking, we also have businesses as well. But generally speaking, it's for that. It's very popular with those over the age of 55, and I think it's either this. Well, it's interesting because the 65 plus age group. That's about 50% of our term deposits. But then there's another group that's just before that age that maybe have paid off their homes or they're saving for retirement, and that's another 20%. So So between that, you've got sort of 70% of the market.
How are term deposits and the scale that's in them, 30% of that big figure held at ANZ, how does that look and how is it recorded on your balance sheet? Are they considered an asset like all deposits that you can then make liabilities against so that you effectively have more lending power the more TDs you have?
Well, it's a bit funny. It's the opposite of what it would be for you as a person. So if you had a term deposit in the bank, you consider it as an asset, right? But when our customers have a term deposit with us, on our balance sheet, it's a liability for us. So because we have to pay that back to the customer and interest and their ultimate their principal as well. So for us, we see term deposits as a liability, and we see lending, so things like home loans, as an asset. So it's the opposite.
So the big question then is, if you can get 6% on a good, about 1 year fixed TD at the moment, how long is that going to last, Ben? Everyone thinks that rates might come down this year. If they do, no matter when they do, how quickly is that pass through? And how big is the pass through? Do you pass through as much in term deposit rates going out as you do in mortgages coming in?
Yeah, it's a great question. We actually pass more, with the rise in the OCR, we've actually passed more in term deposits than we have in the fixed interest rates for home loans, for example. But it's tricky, right? Because from an OCR perspective, you know, the economists are forecasting that to change later this year, and Reserve Bank's saying maybe a bit longer, and so no one sort of knows. But you know, when the OCR changes, that impacts term deposit rates, as it does for lending rates on the other side. But then also wholesale rates, international money markets overseas impact both lending rates and what we pay for term deposits as well. So there's a mix of sort of reasons why we price things. But I would say, you know, as I think we're probably close to, and I could be proved wrong here, but close to the peaks in the interest rate cycle at the moment. And then hopefully over time we will see lending rates come down, which I think will help a lot of people because there's a lot of stress out there for that in that space. And then also I think you know, you might see commensurately you might see term deposit rates come down a bit as well.
I do want to talk to you about that sort of pain that you are seeing in the borrowing side of the economy at the very end, but just still on TDs. So it's not in ANZ's interest or in any bank's interest to have more people in term deposits?
No, we want people to have term deposits. We want people to invest their money with us, whether that's in savings accounts, transaction accounts, or term deposits. Term deposits for us it's unique because we use it to help give us funding certainty, and that's why we have break fees. If someone breaks, for example, a term deposit, you know, if they have a transaction account, if they take the money out, that's fine. If they have savings accounts, that's fine. But when we have a fixed term agreement through a term deposit, well then we hedge that with a commensurate a funding sort of interest rate hedge. It gets complicated.
I get it, it makes sense. Yep.
But so that costs us money.
You bank on them keeping their money in for a certain amount of time, and if they don't, then you charge them for it.
Correct. And so it costs us money if we have to break that, and so therefore we charge them for it.
So how much do you charge them in a typical break fee?
Yeah, so a good example is, so if a customer had $10,000 with us in term deposit, they invested it for a year, say 6%, and after 6 months they wanted to break it, then we would let them break it. They'd have to give us 31 days notice, unless it was hardship, but we'd let them break it, and they would, instead of getting 6% interest, we would take 1% off, and they'd get 5% interest for the time that they've invested it in.
That's not bad.
It's not bad, and it differs for different banks. Different banks have other calculations, but that's how we do it. We think that's fair based on, you know, our costs and what the customer signed up to.
But if they break 1 month into the 12 month, you charge them more, right?
Yeah, it's we don't charge them more. It's the same calculation. They just get less interest because they've only had it for 1 month. You're sort of earning interest, right? So, yeah, so roughly about 5% of our customers, or slightly under 5% of our customers, break during their term, and the majority of those are customers that just need the money for something else, not hardship. Only about 1% of our customers actually break for hardship, and that's things like unexpected medical costs. But the bank's pretty flexible around, you know, if someone's in a hard situation. For example, during the cyclone and floods last year, we let customers break when they needed to because of the situation they were in.
I remember. Is there a most popular term 1 year, 18 months?
Absolutely. So the 6 months and the 1 year are by far the most popular. They account for about 2/3 of all all deposits that come through to us. And within that, the 1 year is by far the most popular. So it's roughly 40 to 50% of all term deposits that are getting placed with us at the moment are sitting in that 1 year term. Yep.
Now, a guy I've interviewed for this piece as well, Ben Kelleher, he reckons that banks are pushing term deposits as a means of investment, which he says is bad, especially for anybody who's younger, because they should actually be allocating that money to a longer term investment to earn more in returns over the long term. What do you reckon?
It depends what the customer wants it for, right? So a lot of our customers we talked about are sort of at the end of their investment cycle potentially, and need it for, they appreciate certainty, so they know what they're getting, they appreciate the simplicity of it. There's no sort of monthly fees, there's no sort of hidden fees around a term deposit, you kind of get what it says on the tin. But he's got a good point around for the customers that are maybe younger, that maybe have a longer investment horizon, then potentially a managed fund or something could be suitable for them. So I think it just depends on the individual customer's situation and how it works for them and what they want to use the money for. So yeah, I don't disagree. I think it's horses for courses for different customers.
No such thing as completely safe. How safe is a TD given we don't currently have a deposit insurance scheme in this country?
Well, that deposit insurance scheme is coming. I think 2025.
It is 2025. Yep.
So, but I guess the question is how safe do you think the New Zealand banks are? I mean, I sit here and I'm pretty confident that the New Zealand banks.
I think they pay you to say that, Ben, but that's okay.
Yeah. But look, I think New Zealand's we're well capitalised. The banks in New Zealand are well capitalised. So yeah, it's I think people are pretty safe. It's never can be 100% safe. But I think people are pretty well looked after in New Zealand banks in terms of safety.
Now let's talk about the other side. We've spoken a lot about savers and what they're doing with their money, especially in TDs. But what are you seeing on the borrowing side? You oversee retail banking in the whole of ANZ, New Zealand. How much pain is actually out there that we're not seeing come through in things like default figures?
Yeah, it's a slow market. So the home loan market at the moment, it's a really slow market. It's quite interesting. So the first home buyer market still stayed pretty strong. In fact, it's lifted from a percentage. Well, certainly that's what we're seeing anyway at ANZ. The investor market, the residential property investors have really run for the hills. That market, sort of three years ago, sort of at the peak of the sort of the market growth for the housing market, was roughly about 35%. Were property investors.
Wow, and they've largely all gone. What's it down to now?
So now we're in the low 20s. So they have stepped back, and I think that's potentially also contributing to the increase in term deposit growth as well, where people may have been investing in property, buying an extra house to rent it out or whatever. They're not doing that so much at the moment, sitting on their hands. So maybe that's flowing into term deposits. But so the market's a funny market. It's pretty low and subdued. It'll be interesting to see what happens in February, March, or later in February and March, just for the fact that these are usually the months where it starts to jump back up. So we'll see what happens. We're not seeing. I mean, obviously there's a lot of pressure out there in cost of living, and we're trying to help as many people as possible. We look at different ways of helping customers through situations that they're in, and so we work with customers personally around that, and proactively reach out to them if we think they might be struggling.
Are you doing that more often now?
We are doing that more often. We actually have a large program of work. We actually categorise people into groups where we think, group one, we think actually you're okay. You might need some support around, some advice around what you do going forward. But actually, we think from what we can tell, if your income and expenditure, that you're probably fine. Group two is probably we're a little bit more concerned about you, and we might give you some more assistance. Like we'll give you a phone call or an email and reach out to you and try and contact you and see how we can help a bit more. And then there's a group that would define as struggling, that we think need a bit more help, and so we'd have specialists get in contact with those people.
What defines struggling? What would that look like in somebody's account?
We'd look at it and go, do we think they can meet their obligations? They might be fine at the moment, but actually their income versus the expenditure might be a little bit on the wrong side of what they obviously want. So we work with those customers as much as we can to, rather than be the ambulance at the bottom of the cliff, we try and get ahead of it. and have proactive conversations around. And a lot of those customers, when we reach out to them, do make changes, which is fantastic, right? So they might be restructuring, they might go into interest only for a while, or
So these are business customers, consumers too, or?
both.
Both.
Yeah. So I'm actually talking in that instance about consumers. Yeah. But we're obviously looking at both sides of the book.
What do you think is going to happen this year? If we don't get rate relief, how many more of those conversations are you prepared to have?
Well, I think the good news is I think people have had time now to see and to prepare for higher interest rates. So we do have customers that are rolling off into higher interest rates, and that will continue for a while, just because of the fixed nature of New Zealand's home loan book.
Takes a while to pass through.
Yeah, it takes a while for it to come through. Whereas in Australia, like, it goes straight to the bottom line
Smack.
because they're all floating, or mostly floating. But in New Zealand, we're fixed 1, 2, 3 years, and so it does take a while for OCR moves, for example, to flow through. And so for us, I think we have seen most of those customers rebase, so they might be on this, the 5s and the 6s. So jumping to the 7s now isn't such a huge jump, although it is, it's still painful, and it gets incrementally harder as it goes up, right? But for some customers that fixed, longer terms out, that we actually do still have a small group of customers that are jumping up. But in general, customers have had time now to prepare for it. We see a lot of our customers that have paid in advance, and are making sure that they are, they have a bit of a nest egg, so they can then absorb that interest rate shock. So that's sort of what we're seeing in the market. We're not seeing a huge amount of what we call delinquencies, so people missing payments. Our credit card book and our personal loan book is actually in really good shape. In fact, it's in really healthy state as to what you might have thought. We'd sort of forecast that it might be in a worse position in terms of people not being able to, given the cost of living, people not being able to manage to make the payments. But actually, it's been the contrary. We're seeing really low delinquencies in that space.
So somehow, crazily, despite what the Reserve Bank's been doing, people are coping.
There is. I don't want to overplay that, because I think there is a lot of stress out there, and I think people are doing as much as they can and are cutting back in areas that's really painful. And we definitely have seen an elevated level of people missing their payments, particularly in the home loan space. But we're not seeing it's not continuing to spike. It's spiked for a while, and now it's flattening out. The one thing we are seeing though is when people go through to missing payments, it's harder for them to get back to making payments again. So in the past, what we'd see is people would miss some payments, and they'd manage to organise their affairs or do something different, or maybe get a second job or whatever it is, and get back into the positive. I think people now, once they miss the payments, what we're seeing from our experience is that they're finding it harder to get back into the green again. So we're having to work really closely with those customers to try and find options to help them. The good news is, though, is that a lot of customers have good equity in their houses. So we've only got a very, very small amount of customers that have really low equity. So
any negative equity out there?
It would be like, you could count it on your hands probably, in terms of customers that are in strife with negative equity. So that's really good news, because it means if customers do need to cure out, they can actually take steps to help them.
So as long as house prices don't fall this year, we're good, Ben?
Look, I think the market's probably stabilised at the moment, but we continue to watch that stuff.
Big year ahead. Thank you so much for your time. I really appreciate it.
Pleasure. Thanks, Madison.
Now, something interesting about Ben, he's actually only one of 3 people at ANZ Bank who are allowed to sign off mortgagee sales, which are the ultimate sign of stress in the system. He told me that he only saw about 15 total all of last year, and most of them were just couples divorcing, wanting to get out of their homes. While the banks could still see more mortgagee sales this year, it really does suggest that the economy hasn't fallen out of the sky yet. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below, and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.